Hello and welcome to a discussion of the solar tax credit and how it might impact you and your wallet. I'm Professor Kai, the solar guy. First, a quick disclaimer. I am not a tax professional. I don't play one on TV or YouTube, but I want to give you an idea of how, after you purchase a solar array, the tax credit might impact you. Let's assume that Jack and Jill have bought a solar array that cost them $25,000. The tax credit is 30%. So they have a tax credit of $7,500. Now this tax credit is a one-for-one, non-refundable tax credit against liability. Quite a mouthful. One-for-one, it means dollar for dollar. Non-refundable means that you have to have liability in order to monetize that tax credit. So one-for-one, non-refundable tax credit against liability. So let's look at that liability piece. This Jack and Jill who bought this solar array, let's assume that their taxable income is $50,000. Assume for the sake of easy math that their tax bracket is 20%. So they have tax due of $10,000. That's their liability to the federal government. Now there are a couple of ways that this taxable amount due and this tax credit can play out. Let's look at case number one, Jack and Jill again. They are of the mindset that they want, at the end of the tax year, to owe the government nothing. So they set up their W-2s such that enough is deducted from their checks that at the end of the tax year, $10,000 has been withheld from their income. So when they fill out their taxes in April, they say, yep, we had taxable income of $50,000, we owe $10,000, guess what? Our W-2 withholding shows that you've got $10,000. I don't owe you anything, you don't owe me anything. Life is good, let's move on with life. But Jill says, hold on a second, John, didn't we buy a solar array? And isn't there a tax credit associated with that? And John says, oh, you're right. And that tax credit is $7,500. So in this case, we've got this $10,000 tax due, $10,000, and then we've got this tax credit of $7,500. So actually, what they owe is $2,500 because this is, again, one-for-one tax credit against liability. They had this liability, which they've already had withheld. They've got a $7,500 credit. So what they actually owe is $2,500. But hold on, the W-2 withholding is $10,000. They've already paid that money into for their taxes. So Uncle Sam sends them a nice check for $7,500 because they overpaid their taxes due to this tax credit. Now, another couple has a different approach to their taxes and how they want to handle it. They don't like to give the government their money to earn interest on over the course of a year. So what they do is they say, you know what, don't withhold anything. I'm going to save enough money such that at the end of the tax year, I have $10,000 in the bank so that when it's time to file my taxes, I just write a check for $10,000 and send it off. So in this same case, they've got $10,000 in the bank, but because of the tax credit, they now only owe $2,500. So instead of writing a $10,000 check, they end up writing a $2,500 check, and they've got $7,500 in the bank that they can use for whatever purposes they desire. So basically, if you have tax liability, the percentage that the tax credit percentage is applied to the total array cost to tell you the amount of tax credit you have. Now, what about, I hear you say, if I don't have $10,000 in taxable tax due? Let's say my tax due was only $3,500, and you have this credit for $7,500. So now you've got $4,000 in additional credit that you cannot monetize in that particular tax year. So what happens is that you owed $3,500, we had a credit for $75, so you don't send the government anything. Your tax bill for that year is $0, and this $4,000 carries over to the next tax year. And let's say in that tax year, you again have another tax due of $3,500. You've still got $4,000 worth of credit, Now you only have a $500 tax credit left over. So again, your tax bill is zero here, your tax bill is zero here, because you've got credit, leftover credit, you've got credit, leftover credit, so tax bill is zero. End of the second tax year, you have $500 left over. Let's carry that over. You've got a $3,500 tax bill again, with a $500 credit, you write a check for $3,000. The moral of the story is, there is a positive financial benefit to going solar. Not only are you helping the environment, but you're helping your pocketbook. So, you have any need or desire to go solar, please give Straight Up Solar a call. We'll be more than happy to talk to you about what is possible on your property and how the tax credit might impact your financial position. But understand, you should always consult with a tax professional to understand that exact impact on your particular case. It's been fun being with you. Professor Kai, the Solar Guy, signing off. See you next time. Have a happy solar day.